Okay. Good evening, everybody. Welcome to this post-Corona financial tips and investment opportunities webinar. I'd like to thank ESRA for allowing Pioneer to present this webinar to their community. We all know of the excellent work that they do and encourage everyone to help support and volunteer for their various charitable activities. Pioneer is one of Israel's leading wealth management companies, established in 1986 with a focus on face-to-face personal financial planning. The company is regulated by the Israel Securities Authority, and Pioneer's focus is on personal portfolios and a very high level of individual service. We have many Olim as clients and are experienced in helping them before, during, and after their Aliyah. Just a little about the technology this evening. Video and sound are turned off for all the participants for privacy reasons. You cannot see each other. However, we can see in the chat box who is participating. Questions or comments can be submitted on the chat panel at the bottom of your screen or on the Q&A box. We will answer questions at the end of the presentation. This presentation is being recorded and will be available to you afterwards if you so wish. I'm joined by Mike Ellis, our Chief Investment Officer. Mike runs our entire portfolio management team at Pioneer. Mike is going to give a brief market review and look at some investment opportunities. Over to you, Mike.
Thank you, Steve. Thank you, everyone, for joining. We appreciate the time. This is not the first time we're doing something with ESRA. It's a real pleasure. I think the last time I presented to a ESRA community was in January 2018. It was right about the time of the Bitcoin phenomenon. And we gave a presentation explaining Bitcoin and why it should possibly not be part of your portfolio going forward. And since then, Bitcoin is down by about half after being down about 70–80%, whereas a straightforward investment over that time would have done well. So at least we've got that under our belt. So I'm going to do a little bit of a presentation now about the market. Can everyone hear me? I see some chats that the audio is not clear. I see some, let's see if I can do anything about that. I'll talk a little bit clearer. Can you hear me now? Getting some quite a few comments on the side about sound. Can you just give me 1 minute and we will see what we can do about that. This camera was checked, so a little bit tricky to get that right. And now, is that better? Stephen, can you hear me? Okay. I hope that improves things. I just switched things over a little bit. Okay, so I'm going to just share a presentation now. And 1 second. Okay. Oops. Right, there we go. Okay, so I think it's important we just review where we are with respect to the virus. I think everybody follows us to a greater or a lesser extent. I've been obsessed about these virus numbers since the beginning and trying to understand where we're going. I think the key point here when looking at virus numbers is not the numbers where we are today. It's all about the trajectory and where the numbers are going. So if we're at nearly 8 million cases today, where are we going to be in 3 months, 6 months, etc. And you can see the trajectory of the daily cases here on the right-hand side. You can see just how quickly it was increasing in March. It was increasing at an increasing rate. This is daily new cases. And the right-hand side was the fatalities, and that was also increasing at a very, very sharp rate, but has subsequently come down and is trending down on a daily rate, whilst the daily confirmed cases is still trending up across the world.
Sorry, Mike. Can you just move a little bit closer to the microphone?
We'll try. One piece, so that's a bit tricky. Okay, I'll try that. I hope that works. Okay, so we've got the trend up of daily cases and trending down of deaths, but not too much information there. Interestingly, when we look at Europe, we often think of Europe as the individual countries that make up Europe. But if you look at Europe as a whole, as sort of one country, because they never really strictly controlled the borders between the countries, the trajectory of the viruses very, very closely mirrors the US situation. So this graph on the right-hand side is the cumulative number of cases since they hit 10,000 cases. So you can see very, very, very similar. But on the fatality side, Europe has been much more severely hit in terms of deaths. Now, you can speculate the reasons for that. Maybe it was the age of the population, maybe it's the quality of healthcare, maybe it's the general health of the population, although one tends to think of Europeans as healthier than Americans. But certainly if you were in Europe, it's a much more serious disease than if you are in the United States. So that was an interesting data point. Then for the people on this call, I just selected 4 countries to have a look at. That's United Kingdom, United States, Israel, and South Africa. I think those are the most relevant for us, English speakers here in Israel. And this graph, it's a logarithmic graph, so everything can be compared one to the other. And you can see the relative trajectories of each country. You can see the how the lockdown has affected how successful Israel was relative to unsuccessful the United States and unsuccessful in England. South Africa, interestingly enough, was partially successful, but is now very much heading in the wrong direction. What I like most about this particular research is the color of the line indicates the trend relative to the amount of testing being done. So if per million of population. So in the United States and in the UK and in South Africa, they're simply not doing enough testing for these data points to even fully reflect the picture. Only in Israel do we have enough testing and we can rely on these points, but unfortunately, Israel has turned a corner and we are heading again in the wrong direction. Okay, so what does this mean for investors and markets? It's becoming a longer-term problem rather than a shorter-term problem. And what does that mean? When this started and the shutdown started, we've all felt that, you know, if we did our bit and played along with the lockdown, then we'd get over this thing. But it's turning into something that we're going to have to learn to live with and adapt to, rather than something that was a temporarily hit. And that has comes with its own set of concerns. Governments have realized how expensive it is to force a nationwide shutdown, and they are reluctant to force further shutdowns. So from the government side, they also don't want more shutdowns. They now have to figure out how to control it with a public that's less cooperative, a public who sort of feels they've done their bit and they're now tired. I don't know about you guys, but I was on the beach in Netanya on Friday, and there was no visible signs of any sort of social distancing, no masks. The bar and pub was full of people. So really, there's a lot less public cooperation. And the governments now also don't want to do further shutdowns. So because they're so expensive and the economic consequences are so enormous. So what does that mean? Second wave? Yes, I think that Israel is in some sort of second wave. Is this a local or a national problem or a global problem? The government will have to deal with it on a localized basis. So if a case pops up at a school, they'll close that school. If a case pops up at a workplace, they'll close that workplace. They won't be able to shut down, in my opinion, they won't be able to enforce a nationwide shutdown. Looking at the countries who were ahead, for example, Asia, in China, if you believe their numbers, they're still struggling to keep it under control. It hasn't disappeared. And they're still forcing social distancing, masks, etc., without a shutdown. So their economies are open, their economies are functioning, but the way of life is certainly heavily affected in those Asian countries, but they haven't had a full second wave. So if the second wave comes, in each country will deal with it on their own, but I think that we have this feeling that it's more of a long-term problem, and therefore we won't see the same panic that we saw in March. And therefore, if we have another major sell-off, it won't be nearly as big as March, in my opinion. Long-term travel restrictions, we're just going to have to get used to it. Post 9/11, we got used to long security lines at airports. Now you're going to have to get used to health restrictions when you travel. And that means you're only going to travel when you really, really have to travel. There will be quarantine requirements on both arrival and return. You may have to wear a mask the whole journey, which will be very unpleasant. I have a client who flew from Sydney to Switzerland last week, and he said he flew via Doha, and the staff on the plane, the air hostesses, were wearing full body hazmat gear the entire journey. So that's obviously a very unpleasant and very intimidating experience, and no one's going to want to do that. So travel is going to be affected long term. It's going to be more expensive to travel. There's going to be less travel options, less flight options than we were used to pre-corona. And the last consequence, which is so visible the last few weeks, is social unrest. And this is something we articulated before the latest incident, that when you've got too many unemployed people who are feeling desperate, your obvious risk is social unrest. Not really an economic risk as such, but it certainly slows down economic recovery and affects confidence and affects the investment cycle. So those are some rather sobering outlook on the market. However, the flip side is, so we're uncertain about the virus, we're uncertain about how long it's going to last, and therefore we have to be uncertain about the economic normalization. But markets are functioning, okay? We've had new companies go to the market, we've had lots of restructurings, we've had new bond issues all over the place. Companies are trading, there's liquidity, the markets, the capital markets are functioning. So that, as opposed to 2008, where it was a liquidity crisis. So here we have a health crisis, we have an economic crisis, but we don't have a capital markets crisis, thank God. And that gives us confidence that an investment plan based on solid fundamentals should be able to ride through this crisis, just like it's been through many other crises before. And I'm sure Stephen will touch on that on his financial planning tips later. Just to review where we're at in terms of fundamentals this year, this is the stock markets, major stock markets year to date. The red line is the NASDAQ, the blue line is the S&P 500, and the green line is the emerging markets. And what you can see, it's funny, we've been using this presentation, this slide, and in all our webinars since Corona started, and each time we're updating it, and the right-hand side just goes up and up and up. So you can see the year started, markets were up, then bang, the heavy hit in March, and then the incredibly strong recovery. So you can, if you invested in NASDAQ at the beginning of the year, you're in positive territory year to date quite comfortably, even after the sell-off of last week. You can see here on the right-hand side, if you can see my mouse moving, you can see the very sharp sell-off last week, Thursday, which was very significant, but in the grand scheme of things, not really. Then the blue line is the S&P 500, you know, the most sort of traditional plain vanilla index out there. You would only be minus 5%, and a more risky emerging market play, you would be minus 10 or 11% year to date. So you can see that this doesn't fully reflect the type of economic damage that we're witnessing around the world. If you take a 12-month view, which is even an even stronger argument that the markets don't fully reflect the damage, you're very positive in a NASDAQ bet. You're in positive territory, about 7-8% in an S&P bet, and emerging markets, you're flat, slightly minus. But really, if you if you closed your eyes a year ago, went to sleep for a year and woke up now and didn't know about Corona, it certainly would not be reflected in your portfolio. So we have to ask the question, why are markets so high? And I've kind of narrowed it down to two main reasons. One, market participants have a long-term constructive view. Not everybody is so pessimistic. And the other is policy contribution, which is extremely significant. So the market participants believe that there will be a recovery sooner rather than later. So whether it's 2 quarters or 3 quarters, sooner or later, everything will get back to normal. There's a tremendous amount of money seeking returns. I know this with my experience dealing with high net worth individuals. I've seen it with the financial institutions that we deal with. There's a large amount of cash sitting on the side deciding what to do. And this is an outcome of several years of waiting and seeing, waiting for opportunities. And so there's a tremendous amount of money seeking returns. And of course, interest rates are so low. So what was producing a return in the past is now no longer producing a return, and therefore will have to be invested in risky assets. And as I said earlier, not everyone has a short-term view. There's lots and lots of money that's in the market that has a very long-term 20, 30-year view. So that significantly keeps the market up. Policy contribution has been massive. Cannot be underestimated. If you look at any graph on a relative term, it's an absolute relative to 2008. It's massive contribution of new money and new debt by the central banks, and full credit to them. They reacted very quickly. This is creating excess cash, and that excess cash is being invested back in the market. That's part of the rationale of why they do it. Fiscal life support in the form of tax relief or helicopter money. Anyone who is a US citizen on this call would have received some money from the US government. If you ran a business in the United States, you could qualify for a short-term loan, which might be turned into a grant if you met the conditions of the loan. All those type of fiscal supports really helped these companies and therefore keep the market afloat. And finally, just an anecdote, federal support is nationwide. So some of the US states that have hardly been affected by Corona are equally able to claim support from the US government. Okay, so here's my crystal ball. Interest rates are likely to stay close to zero till at least 2022. So that means if you're sitting in cash a year ago, you would have got 2% on your dollar fixed deposit. And now you're going to get close to zero. Equities, we favor equities. You should keep the equities you have if you're nicely diversified and they're good names. We have a bias towards the USA. We still think that the USA is relatively stronger than everybody else. The market is pricing in a shorter term economic damage. One has to be aware of that there's a risk of volatility at least. Upcoming elections in November. 2 months ago, it looked like Trump was going to walk it. It's now not so clear. It seems that the vote count will go to Biden, but I'm not sure how the electoral colleges will go. But I do think that if Biden wins, other than potentially higher personal taxes for individuals, I think he will have market-friendly policies because he's entering on the back of a very weak economy, and he's unlikely to shake things up too much. So that's not something we should fear, regardless of your politics. It's not something we should fear too much from a market point of view, at least. A lot of discussions about China and US. This is a very complicated subject. Bottom line is we think China is a very strong economy and deserves its place in your portfolio. Yes, there are issues with the US, and yes, there's a risk that things can go a little bit south, but I still think China is a very strong economy, a very large economy, and needs to be part of a global portfolio. Inflation, unlikely to spike anytime soon, in my opinion. We've got at least 2 years before the consequences of the US monetary policy starts biting. That's and therefore we have no problem holding bonds in the portfolio, squeezing out commensurate return relative to their risk. And so we like bonds. We're fully invested in our strategic asset allocation for bonds, but we're not. So we are aware that inflation could be on the horizon. So it's not clear. I believe we got a question about gold prior to the call. One of the registrants asked about gold. So gold fell out of our strategic asset allocation. When we build a portfolio, we follow what's called a mean variance optimization process. For each asset class, we put in a volatility, a correlation, and an expected return, and then we put it into an optimizer. And gold fell out of our optimization process quite a while ago, without regard to the current situation. If you buy gold now, it might work. We're not buying it, but it might work going forward. Certainly, you have to realize that you're arriving late to that party. The gold has come up very, very nicely. Post 2008, when the initial wave of quantitative easing was used to rescue the markets, everyone said gold is a guaranteed winner. Okay, so 2008 till 2010, gold went up, slowly. And then people realized, oh, inflation is not coming. These quantitative easing.
Mike, can you just speak a bit louder? Some people have asked if you can talk louder.
Okay, I'll try. It's fine. So we're talking about gold. In 2008, the quantitative easing, everyone said that quantitative easing would lead to inflation, and everyone started buying gold. Gold went up 2008 to 2010. Then the market realized that the quantitative easing is not necessarily inflationary, and gold fell out of bed and halved in value. It went from about 1,700 all the way down to 900 again, and then has slowly begun to rise again. And now we're back at $1,700 value. I'm reluctant to buy it at this value. I see the logic. The research doesn't support the logic, but people think that gold is a store of value against inflation. You know, this argument was true in the 70s. I'm not convinced it's true now. But if you buy gold in your portfolios, you have to be aware that you're coming very late to that party. Okay, so what to do? Stephen will talk a bit more about this from a financial planning point of view, but obviously one has to be focused on long-term goals. It's going to be extremely difficult to time this. You have to avoid the temptation of reading the newspaper every day and then trying to make an investment decision. That's a guaranteed way to destroy wealth. One cannot, we're in a high volatility time. One cannot manage money on a day-to-day basis. One needs to build a strategy that's relative for yourself and for the time, and stick to it. We're optimistic for the longer term, cautious for the shorter term. I'll explain what that means. But we do think that the world will return to normalization eventually. In terms of cautious, we're underweight our equity allocation. So if a client signs a mandate of 30% or 40% equities, we're only about 65% of that equity budget invested. The rest is in very low risk investments. So that's our cautious approach. We're holding back a little bit. We're fully invested in bonds, as I said earlier, and we do think that bonds offer value over cash. There will be opportunities along the way, so we need to keep some money on the side for that. Don't bet against the USA. Anyone who follows Warren Buffett, he gave a presentation online about 2 weeks ago. He made it very clear, don't bet against the USA. So whilst the USA has certainly got major challenges ahead of it, I kind of agree that they're still the strongest in today's world. New property investments, we're waiting. We want to see how our existing property portfolios are coping with the corona challenges. I would hold back. I would hold back till at least the end of the third quarter. perhaps even the fourth quarter before allocating new money to US property, unless there's a very compelling argument for that. But we're holding back on new property investments. In the alternative space, because property is now off the table, or temporarily off the table at least, we like structured notes, we like certain specialist funds. We are doing a slightly contrarian allocation towards China, as I think, as I said, I think China has its place in a portfolio, and those are the types of things that we're doing. And I'm sure that Stephen can discuss this with each of you individually. So that's all from my point of view. I'm happy to answer questions. Stephen will now give a presentation on some more financial planning side of stuff. Feel free to type in a question and I will either deal with it in the chat or openly after Stephen. Thank you very much.
Okay, I hope you can all hear me. Thanks very much, Mike. My name is Feigenbaum. In my 20 years of financial planning experience, we haven't been hit.
Please go to presentation mode.
Sorry.
And then presentation mode. Sorry for interrupting.
1 second. Your screen sharing. Okay. Sorry for this. Sorry, just get the.
Let me.
Okay.
No, share your screen. You stop sharing your screen. Oh, good. And here, exactly here. Below on the left. Yes. Press that again. Great.
Sorry for that. I hope you can all hear me. My name is Feigenbaum. Thanks, Mike, for that great presentation. In my 20 years of financial planning, we haven't been hit by an asteroid, but it clearly feels like one. Global stock markets have never looked so volatile as they plummet on the back of the coronavirus crisis and then sometimes yo-yo back up. It's a pretty exciting ride out there. Well, some may think so. To some extent, we are lucky because the recovery of the markets, well, until last week, has allowed us to look back at how we felt during the crisis. Towards the end of March, when the markets were down approximately 30%, you might have been stressed or panicked. At that moment, were you thinking, I should have done this, but now it's too late? Well, you've been given an opportunity to address this and make the changes without delay while breathing a sigh of relief for the respite. And why do this immediately? Because of human nature, we tend to forget and move on until the next crisis comes along. So, what should we do? Make a plan. You know, if you have a realistic plan, all right, and you already have one, then it's time to refine it. And if you don't have one, certainly a good opportunity to start and do one now. Often, we have assets spread around with different managers or financial institutions. Have you looked at them as a whole and not the individual pieces? I recently met with some prospective clients, and they invested in the US and 3 separate companies in Israel. So I asked them why 3 companies locally, and they replied to spread the risk. What they don't realize is that the Israeli market is really a very small market, and each of the portfolios that they had here had similar holdings, so they weren't spreading the risk or even more diversified. When I asked them about their US investments, they said those have been doing very nicely, but they actually had no idea what they were. So this is something I hear time and time again. I'm also amazed at how few people work with financial advisors. And of those that do, more surprised to hear that their portfolio managers hardly were in contact over this difficult period. You should review your asset allocation to make sure that it reflects your current and future goals, extremely important, your time horizon, and your risk tolerance. Some or all which may have changed since you last updated your financial needs. Once you know this, you'll have a more concrete plan, and then you'll be able to move forward with it. Review where your assets are held. That's my next point. One of the major consequences of the coronavirus pandemic is that our ability to move around freely has been restricted. Mike mentioned that. Mobility is no longer a given. Who would have thought that flights would have been closed or grounded for the last 3 months? I've also heard that there's some banks that don't allow transfers, overseas banks, unless the client is physically there. Having your money far from home restricts your ability to liquidate and receive funds, especially when you might need them. So consider moving your overseas assets to Israel. There's no longer any restriction on managing dollars, sterling, or any other major currency through the local banks. And as a result of fierce competition here between the banks, the management fees are actually quite low in comparison to overseas institutions. You should use a local advisor who works with the banks to offer a secure platform, someone who's familiar with the tax regulations and tax implications for you here. What's important to know is that any investment advice given to someone who lives in Israel, whether you're dual resident or not, should be by a financial advisor who's licensed by the Israel Securities Authority. Why? This is in order to protect you, the investors. Those advisors are highly regulated. Another benefit of using a local advisor is that you can also he can help you navigate through the local financial products. And that can include pension, kranot hishtalmut, because in my experience, when talking about various financial local products, I'm constantly told by my clients that they do not understand them. Rebalance your currency exposure. That's another tip. Whoever thought that the US dollar would be 345 to the shekel and the pound only 436? I'm sure there's a few British people amongst you, and I don't need to show you this graph because it's unfortunately not a very happy story. In terms of the US dollar, it does fluctuate, but its average has been 3.67. So sometimes you're on the winning side and sometimes not, but it's sort of maintains a steady value. I've met and spoken to many Olim, whether they've recently made Aliyah or been here for many years, and they clearly have a mismatch in their currency. By this, I mean that they're continuing worrying about when is a good time to convert to shekels. If you live in Israel, you should have a high percentage of your money in shekels. It's after all, it's where you spend most of it. If you don't, then you should have at least 6 months cash shekel reserves. There really is never a good time to convert. At least this way, you'll not have to be constantly worrying about what the exchange rate is. Don't try and time the markets. And if you can see, the Fed basically are certainly going to stimulate it as much as possible. It seems that they've decided whatever the cost, they're going to stimulate it. But we don't know when or how they're going to do it. And that's why trying to time it exactly is really very difficult. I've never been busier talking to potential and existing clients or sending market updates to keep clients informed about the markets during this lockdown period. The number of times I've had to reassure clients that selling when the markets are low is not the way to go. Rebalancing or adjusting during a crisis can be done and is possible. However, it should be done with due care, knowledge, and in a non-stressful environment. This slide here shows the S&P between 2008 and the end of May this year. And what it highlights is that in the short term, markets can be volatile. However, the longer term, it's less relevant. And It's extremely difficult to know when the right time is. However, on average, it has appreciated over the years. Someone I know was panicked, and they decided to sell in the middle of March, thinking that they'd be able to get back into the market when it started going back up. Well, because of all the volatility and uncertainty, and they were investing themselves, they still haven't gone back into the markets. So far, they're down about 20% this year, while most portfolios have recovered, are only slightly below their values at the beginning of 2020. If you want to invest in the markets, consider drip feeding your money bit by bit. This way, if the markets go down, at least you're buying at a cheaper level. And if it continues to go, and it'll smooth out your returns with the hope that they recover and grow in the longer term. Point number 5, managing your risk. And this is always one of the points that I have a big discussion with clients. Part of what I do is to help clients decide what level of risk is right for them, what is going to make them comfortable with a portfolio that will meet the expectations of return, and at the same time accommodate their appetite for risk and their level of volatility which they're prepared to take. Low interest rates, well, Mike mentioned it, are here to stay, and it's a problem for people who want income. So just looking at the 10-year government yields, it's quite a joke because Israel's 0.75, the US 0.7, and the UK, I think it's even now below 0.3. So if you're looking for a higher return, you may be forced to up your risk spectrum. And this means in order to do that, you have to diversify the risk. Mike mentioned alternative investments, which is part of it. And also, you can consider thematic investments. What does that mean? Some specific themes because of what's happened in the coronavirus era. Some of them are health technology. The crisis has certainly exposed cracks in the healthcare system and across the whole world. And the expectations is that the technological developments in the field will play an increasing role in treating illness, driving down costs, and expanding access to care. My brother's a doctor, and while it's not ideal, he managed to treat many of his patients virtually, something that we would never have thought about before. This will certainly change the way we've been doing things. Fintech or financial technology. The pandemic will likely accelerate the shift towards fintech-based solutions because of consumers buying more online, video streaming, ordering food delivery from home, online education. All these things use financial technology via your mobile or online payments. Another place is e-commerce. In-store sales have obviously been affected. Shops were closed. Nobody could buy anything. And online sales appreciated. Nike, funny enough, reported that their digital sales or online sales increased by a triple-digit rate in China while in lockdown, and surprisingly accelerated further even after stores were reopened. So that means that people have actually changed after this crisis the way they do things. Another one, automation and robotics. The vulnerability of global supply chains over the period was clear, and some growing trends resulting from this will be warehouse automation. We've seen Amazon and all of them, they were so busy over this period, as well as robotics to automate factories. The manufacturers can continue to maintain production in the event of a similar crisis in the future. Ladies and gentlemen, to sum up, financial decisions are complex and often intimidating. There is no substitute, whether before or after a crisis, to having a sensible, realistic plan of action. And remember, try and limit your doses of market news over this period. I'd like to thank everybody. I mean, we will answer questions in a minute. I'm just going to thank ESRA for everything they've done. I want to just mention something about ESRA, that they are the biggest English-speaking network in Israel, which for nearly 40 years has embraced the social needs of immigrants and supported the less privileged in Israel. They are a wonderful organization, I'm sure you're all aware, and we are very grateful that they allowed us to present to their community. I'd also want to thank Yardena from Pioneer, who's run the Zoom meeting, and Mike Ellis for his presentation. And we're happy to meet over Zoom, face-to-face. There are many issues. We've only just scratched the surface of how you can change and adapt in this new environment. And we're going to open it up for questions now. So please feel free to send them through.
Okay. Right. I'm going to I see there were a lot of comments about sounds. I'm really going to speak close to the mic. Forgive me if the camera is right up my nose. But okay, so there's a couple of questions. Firstly, we received a number of what are structured notes. So on the Facebook, on the Pioneer Facebook page, we did a whole webinar on structured notes. Basically, a structured note is an agreement with a financial institution where you are trading off some of the upside for some downside protection. Those are the type of structured notes we like. It's a very wide theme. There are lots of different types of structured notes, and banks offer them, and some of them are more risky, some of them are less risky. So it's difficult to paint it with one brush. But we like them when they are index linked, not single stock linked. We like them when they are medium term, not too long, so 3 or 4 years as opposed to 6 or 7 years. And we like them when they're issued by a very sound financial institution. So we're trading off some of the upside in return for some downside protection. So this is a piece of financial engineering which is available. It's quite common in today's world, and we like it because we can balance the uncertainty going forward and still get a meaningful return. So that's the structured note. There was a question about vaccines, that if my thesis is right, that the virus is long-term in nature and not short-term in nature, why don't we include in that the prospect of a vaccine? I'm not an expert on this, but my reading is that there may be a vaccine in the short term, but it's going to be, just think about a vaccine has to be invented, it has to be tested, it has to be rolled out on a global scale. I mean, to produce X billion vaccines and to implement it, just that is several months. So some skepticism about the short-term impact of a vaccine. There was a question about inflation and how soon. Very difficult question to answer that. If you watched Powell's address last week, when the chairman of the Federal Reserve gave a speech, he said, even those guys don't know exactly when inflation will come, but they're watching it. And because of the uncertainty which stems from the virus, everything stems back to the virus, it makes forward-looking decisions like this very, very difficult. If inflation happens, okay, I believe that the Federal Reserve will let it run ahead before they start increasing interest rates, because we've got some serious catch-up to do, and the size of the US debt is so enormous that the only practical way to get out of the US debt is to inflate it nominally over time, and therefore they will allow it to overrun. So their inflation target is 2%. If we get to 3%, they'll, I think they'll let it run at that course. Inflation is not all bad as long as it's kept under control. It's good for equities, it's good for property prices. If you have a functioning employment market, it's okay, but there's too many unemployed people, there's too much fancy technology which keeps prices down. Who knows? It's a really difficult question to answer. When will inflation come? Okay, So that's, we've dealt with structured notes, vaccine, oil and gas pipelines. I don't have an opinion on that particular asset class. There's, we've looked at it in the past. Unfortunately, what we found with the, so these are master limited partnership, MLPs. What we found is that they were too highly correlated to oil and gas prices. So you think you're getting a pipeline which is going to earn cash no matter what, but in reality, you're getting an investment which is highly correlated to gas. And as you know, gas prices are all over the place, so you're getting a very, very volatile investment. So we've avoided MLPs. Do we use put or call options? No, we don't use put and call options directly. We would use, inside the structure notes is optionality. So we do use that, but puts and calls, we're very strategic in our portfolio construction. Now, when you buy a put option, that's a very short-term form of insurance, and it's very, very expensive. So hedging in the short term is an expensive way. We prefer to build a portfolio that will tolerate the ups and downs based on the risk tolerance of the client, and that way we don't need to hedge it in the short term because the cost of hedging in the long term is expensive. Okay, hold on. Some questions just disappeared. That's options. What about the market in Europe and the euro? Wow. Okay. So the euro, we've over the years have become euro skeptics. I think that the challenges of Europe are enormous. They've got incredible structural challenges, and it's unlikely that we're going to, and they have to come out of negative rates. So we started selling Europe in 2019, long before Corona, and we've unlikely to start buying it until we can see some really convincing arguments. The big problem with Europe is they don't have, despite the Eurozone and the complexity of running the Eurozone, there's no companies there that are new age companies. There's no Apple of Europe. There's no Google of Europe. There's no Facebook of Europe. There's no Amazon of Europe. And these are the monsters. These are the giants of the world. There are those type of companies in China, Tencent, Alibaba, etc. So whereas Europe, they simply haven't adapted to the new age in my view. So whereas Europe is kind of fallen off. The euro, the exchange rate, I really cannot see a significantly strong euro in any time soon. Maybe the dollar will weaken, but I don't see a strong, and that would cause the euro to strengthen a little bit or look like it's strengthening, but I really can't see, there's no fundamental reason for a strong euro. Last question, what are your thoughts on residential properties and investment? Wow. Okay, so this is a long-term debate. Obviously, we manage money, and that's our main skill set. We do include property in a holistic planning for clients, and I think that property is part of the solution. Property, you shouldn't have property disproportionate to your overall plan. So property belongs in the plan. However, in Israel, I think that we've come to a point of excess supply. If you see how many construction sites and how many for sale signs, l'mechira or to rent signs, you drive around and you see that we're on the verge of excess supply, and they're still building. There's still a lot of building projects that are raising money, raising finance, and I think that your probability of upside in an apartment that costs under 3 million shekels, your possibility of seeing a decent return there are very low. At best, you'll get a couple of percent if you get a good tenant who pays and stays and doesn't break anything, and it's a decent apartment, but you're not going to get the capital gains, in my opinion, that you got in the past from unless it's a really special apartment in a really special place, because of the huge supply that's going on. In the high-end property, the sort of 10 million shekel and above, it's extremely soft. And if you're, my understanding is that the number of people willing to buy properties of those values is a lot less than it used to be. There's been a big, the demand for those type of things has evaporated pretty much. So the market above 10 million, very, very soft. And the investment, simple properties above, I mean, property experts will disagree with me, but that's my opinion. Okay, hope that answers that question. It looks like I've answered all those questions, so I think we're going to sign off. I express my thanks to Ezra and to Stephen and to all of you for the time and listening to us. I apologize for the sound issues that we had. We'll fix it for the next time. So thank you very much. That's us signing off.
Thank you. Good evening.